This is Chapter 14, Video 1. Let's launch. Okay, everybody, so this is Chapter 14. I'm going to be honest with you, this is my favorite chapter. Of all chapters that we have in the book, this is really my favorite. And part of the reason why is because, I've kind of told you guys that, I had various options in my career. If I couldn't have gotten into HR, couldn't have gotten into accounting, I could easily see myself being a real estate agent. I think I'd be pretty good at it. Just got to make sure that you're keeping on top of stuff and then also making sure that you're taking care of clients. It's definitely something that I've always enjoyed. I have a very close connection to the Realtor Association, mostly a personal one. My professor at my university that taught me about property transactions was the lobbyist for the Realtor Association. So I think for the most part, I have a strong affinity, and real estate agents used to be a really good resource for me for picking people up. It's been tough lately because a lot of times the realtors aren't even bringing that up, I guess, anymore. But it's been interesting to say the least. But I've actually, like I said, I used to do a lot of work with the Realtor Associations. I used to be a member of DAR, used to be a member of NVAR. I used to teach tax classes at GCAR. So, those are some really good places that I've been involved with. So let's talk about tax status of a dwelling unit. Okay, so I know most of you guys are like, dwelling, wow, that sounds so Dungeons and Dragons style. And that's true. We used to say that in D&D a lot. But so dwelling, which is the bigger thing, is a home, condominium, mobile home, not a motor home. Well, motor home could be. We could look at that too. But it also could be a boat. Actually, funny story, while I was in the Navy, one of the commanders that I worked with who did pick up captain, he and I were PRT buddies. Every time we did our PRT, we'd hold each other's feet, and we always, yucked it up and have a lot of fun. But he I remember him telling me he was he was the bachelor's life. Had his own boat, $150,000 for his boat, and he said it's actually better than some $300,000 homes. And if he ever moves from like one base to the next, he just puts out to sea, and it's a pretty good deal. So it's one of those things that he actually enjoyed. And again, there's certain requirements you have to have in order to be able to do that, but it can happen. So dwelling unit can be solely for personal, a mixture of personal and rental use, and solely rental use. Now, when you're thinking about this, I want you to think about a straight line. And on that straight line, there's two ends to it. And the straight line goes through those two ends. Okay? So the amount that goes through this one end, we'll talk about this when we get into class if you're in my in live class. And if you're watching this as in part of the distance learning class, this is an extra class anyway, so I can explain it to you if you want. But basically, for example, what you're going to do is you can imagine a line that goes through these two vertical lines. Okay, on this side of the vertical line, you're going to have rental income. On this side of the vertical line, you're going to have personal use only, no rental income, and then you've got this area in between, which is going to be called vacation property. And that's what number 2 is right there. Number 2 down below is actually going to be your vacation property. Okay, so you want to be able to take a look at that and understand what that is. Now, actually, let's see. We'll see how this goes. So, whether it's a dwelling unit as residence or non-residence for tax purposes depends on how it's used. Again, so if you have personal use days are more than the greater of 14 days or 10%. So I have a rental property. I've told you guys this in class before. I have a rental property in Maryland. Say my tenant, and say I don't live in the Washington, D.C. area, maybe I'm up in Pennsylvania. And I miss D.C. I like it here. But I've had a tenant who's there, and they call me up and they say, Kevin, I'm not going to live here after the end of my contract. And I'm like, okay, I'm going to go down. Once they move out, I go down to my own old property, and I decided I'm going to live there for 21 days while I go ahead and fix it up and get it ready for renting out again. What will happen is, for this tax year, it is no longer considered a rental property, and instead, it is considered a vacation home. because I have busted the 14-day maximum limit. Okay. Again, if I come down, maybe I only use it for 7 days while I'm fixing stuff up. Then I'm okay. Okay. So any expenses that are attributed to those 7 days are not deductible, but it is still considered a rental property. So that's why it's very important for you to be able to follow this. Okay. So if personal users are more than that, it's going to be considered a vacation home. If it's less than that, it's going to be considered a rental property. Okay. Personal use days do include days tax per owner stays in the home. Days a relative of the owner stays at home. So, say for example, again, maybe this happens. He moves out and my son decides he wants to move in because he's going to college down here while I'm up, we'll say in New York. The fact that he moves in there, now it's personal use. Okay, all that's going to be personal use. It doesn't matter if they pay full fair market value rent or not. It does not matter. It is still not considered a rental property. Okay. If you have days a non-owner stays in the home under vacation home exchange or swap. So for example, I have a home down here. A buddy of mine has one up in Deep Creek. He doesn't live in the area. He says, I need to go to DC in order to be able to do some stuff. I'm like, good. For an equal amount of days that you live in my property, I can live up in yours. Okay. That's not considered rental property anymore. Now you're using it for personal use. Days that a taxpayer rents it out for less than fair market value. This is a very critical thing. I've had several times where taxpayers, and you'll know it. It's in the Washington, D.C. metro area, and they rent it out for $600 a month. And I'm like, well, why do you do that? Well, they don't make much money, so I decided to take care of them. Now you put yourself in a bad tax spot because technically speaking, that is no longer considered a rental property. And by the way, the money that they're paying you is now a gift. Okay. Or it can be considered compensation of otherwise that you don't get a deduction for because for that. Okay. Rental days include days when it's rented out at FMV and then days spent repairing or maintaining the home for rental use. Now, my example that I gave said, again, days spent repairing and maintaining the home for rental use. But what if I live there? If I live there and I'm repairing it and getting it ready for rental use, it will be considered personal use. Okay, so days that the home is available for rent but not rented out are personal, or are not personal or rental days. Okay, that means it's days of non-usage. So, for example, if I have it for 3 days, where it is, say for example, that guy moves out, takes 3 months to have them move back in. What ends up happening is I have to deduct those 3 months it's not being rented for consideration of whether I bust this rule or not. You notice that when we go back to this, it says here 14 days or 10%. Why 10%? Because say, for example, if I only rent it out, and maybe I only rent it out for, 100 days every year, then I'm not worried about the 14-day rule. I'm worried about the 10% because 10%, 100 days, 10% of that's 10 days. That's more important to me than the 14 days is. Okay? For a given year, like it says, it can be a principal residence, a residence that's not principal, or a non-residence. In other words, it's a rental property. Okay, those are basically the three things. Now, if it's a residence but not principal residence, what does that mean? Well, it could be an investment. I own the house because I'm looking for capital appreciation, but I don't live in it, but nobody else lives in it. Maybe because I decided not to rent it out. Renters are kind of a pain in the butt. I'm going to wait for some capital appreciation to take place on it and sell it. Okay. Generally, this doesn't happen very often. Or if people do, they have multiple houses, but because your principal residence is in one location, you have another house somewhere else. We have some clients that have done this. So they live in Florida. They come up here to the Washington, D.C. area for 5 months, and they go back to Florida, so they don't have a trigger having residency here. Technically, that's not your personal residence, and so that's going to be kind of what's important there. Okay, tax provision by property type. Your home mortgage deductions. These are going to be the different types of deductions that you get. You can take home mortgage interest if it's not principal with certain limits. You're still hitting the $750,000 limit. Now, if I take that rental property and I say, look, I'm not doing this it's just a house that I have as an investment, now it becomes investment. and I can take investment interest instead. That might be limited to the investment income limit, but at least it rolls forward and I can deduct it later on. Okay. Whereas if I go above the $750,000 for mortgage, guess what? I lose that. It's gone. Doesn't exist anymore. So that's one reason why you might want to take into consideration taking a home and moving it over towards that. So the tax, non-tax consequences. Non-tax consequences of owning a home. When I go to realtors and I talk to them about selling the idea of buying a house versus renting, because what will end up happening is somebody moves to the area and they'll sit down and they're going to go meet with a realtor, because the realtor will either help them with rentals or with buying a house. Of course, the realtor is going to make more money if you actually buy the house instead of if you rent it. But sometimes, what do we do in order to sell this to people? And this is something that I would actually talk to them about. When you're talking about the fact that it's an investment, yeah, it's a large investment, but it's going to be the largest investment that you have. But it's something that grows. It's something that's yours. It's something that you get to keep once the loan's, of course, paid off. Potential for a big return or loss on the investment, I would say more often than not, it's going to be a gain. If you buy in a really red hot market and then you try to sell within 2 to 3 years, you're probably going to lose money. But if you hold on to that house for at least another 5 to 10 years later, you'll do fine. I had a house that I bought at the height of the real estate market back in 07, 06, 07. It went down, no kidding, 40%. I resisted the temptation to sell, and what I did is I held on to it. Now I'm going to sell it for a 20% gain. Okay? The most important thing that we say here is don't panic. Don't panic. Don't panic. Okay? There is a risk on default of home loan. Again, if you lose your job or you don't have it, that could be an issue. There's some time and cost of maintenance that you may have to deal with. They say limited mobility. I would say, in the markets that we've had lately, I'd say selling the house is pretty good. Obviously, if your house is underwater because you owe more than the house is worth, then it's an issue. But generally speaking, that's not going to always be the case. And again, the tax consequences, you do get the interest deduction. There is a gain on the sale of the house, and that's something we're really going to talk about. That's another reason why I'm very excited about this chapter. Real property taxes are deductible. Of course, we have the SALT limit. That's something that actually kind of is a pain in the you-know-what. And then we have the rental and business use possibilities, which we'll talk about in the subsequent videos. So typically, your gain or loss is going to be recognized in the house if it's sold. It's going to be a capital gain. Now, because it's a personal use asset, any loss is non-deductible. And I've had people come back to me and say, why is that the case? It's unfair. And that's because of the gain exclusion that we're going to talk about right now. Okay? The gain exclusion is $500,000 for married filing joint, $250,000 for everybody else. So if I bought a house here in Virginia, we're going to sell it. If my gain, because I'm married, is under $500,000, I will pay zero tax. Okay? That's good. And here's the thing, and actually, give me a minute. I'm going to tell you guys a quick story. This gain exclusion actually was not fought for by the Realtor Association. Congress came to them and said, "Look, this is what we're proposing. What do you think?" And the Realtor Association about dropped its jaw because they saw the benefit of this. One of the reasons why the IRS and Congress wanted to get away from the previous treatment is that in the old days, if you sold it because there was no gain exclusion, you could do a 1031 on the sale of your house. And if you remember in chapter 11 when we talked about 1031s, that's going to be where we kind of talk a little bit about some of this stuff. But you could do a 1031 on the sale of your house. The problem is keeping up with that is a massive headache for the IRS. So it's almost cheaper to just say, look, if it's your principal residence, we know you're not doing this simply because you're trying to game the system. We'll let you sell it. If it's under $500,000, we don't even want to see it, okay? Unless a 1099-S gets issued. All right, then you have to meet the ownership and use test to qualify for the exclusion, and we'll talk about that right now. Ownership test is usually not hard to meet. If you live in the house and you own it, if you own the house, whether you live there or not, doesn't matter, okay? You can own, the ownership test is pretty easy to meet for most people. You have to have owned the property for a total of 2 or more years during the 5-year periods ending on the date of sale. For married taxpayers, either spouse can satisfy this requirement. So if say, for example, I'm single, I buy a house, later on meet my wife and get married. 3 years later, a year later, we're going to go ahead and sell it. If I've owned the house for 5 years, the whole thing, $500,000 wiped off, basically because people don't think you're going to get married for a tax benefit. Generally doesn't work that way. So that's not going to be the big thing. The requirement is meant to prevent the taxpayer from buying a home, fixing it up, and soon thereafter selling it and excluding the gain. That is true. They don't want you to become house flippers and take advantage of this and then have 100% tax write-off. And plus, it's a pain to move from one house to the next. It really is. So this is something that you probably want to do. This use test is where most people bust it. And that's because they'll buy the house, they move away, they try to take it as a rental, they can't, and they can't rent it out, and they want to go ahead and they want to sell it. Or you decide that you've got two houses, you move to the other house, have a health issue that you have to stay at the other house, then you don't have enough use on this in order to be able to do it. And that's why timing is such an important thing. If you find out that your clients have moved from one house to the next, you should be starting a clock and saying, okay, we need to help you manage this use test so that you can get it. But this is where people are going to get into trouble more than anything else. There are some some exceptions to this. It does apply if you have a non-qualified use of the house on or after January 1st. Non-qualified use is basically the time that the home is not the taxpayer's principal residence. Non-qualified use does not include any portion of the 5-year period that on the date that the sale is after the date that the property was used as a principal residence by the taxpayer or spouse, and the amount of realized gain eligible for the exclusion is reduced based on the ratio of non-qualified use as a dividend by the period of time the taxpayer owned the home. Okay, so that's very important to be able to see for that, and unforeseen circumstances. So if you have to sell because of an unusual circumstance, the exclusion is available, but it's reduced. Very common when I'm dealing with military people. I buy in the house, I live in the house, boom, we have a war over here. I get orders and I got to move someplace across the country. Okay, I got to sell the house because I got to go buy my new house over here. You can do the gain exclusion, but it's going to be pro rata. So you're going to take the ownership use requirements. You're going to take the shorter of the two, divided by 24. That's your percentage that you're going to multiply by either 500,000 or 250 in order to be able to figure out how much of the gain exclusion you're going to get. Okay, so this is going to be the formula for determining it. You can pause the video at this time. You can look at it a little bit more in detail. Taxpayers are allowed to deduct home mortgage interest and a limited amount of acquisition indebtedness. Right now it's $750,000, and I think we'll talk a little bit about the numbers here in a second. But for the acquisition indebtedness is basically debt to acquire, construct, or substantially improve the property. I actually had a client this year of all times. He decided to borrow extra money in order to go buy solar panels. So not only did he get consider this acquisition debt because that's an improvement, a substantial improvement. Also got a tax credit for 30%. So it's a win-win-win for them. Okay, it was a really good deal for that. Okay, then there's limitations on the home mortgage interest expense deduction, acquisition indebtedness limit for debt incurred after December 16th, 2017. The principal loan balance limit is $1 million, and then for anything that's after December 15th, 2016. It's $750,000. Okay, so again, if it's before December 16th, $1 million. After December 16th, $750,000. So the loan that's secured for the home is used substantially to improve the home is considered acquisition debt. Again, even if they call it a home equity loan, that doesn't matter. The most important thing is how did you use the money. So if I go back to my house, my kitchen stinks. I actually don't like my kitchen. I really hate my kitchen. So I go to my wife and I say, look, let's go borrow another $100,000, improve the kitchen, at least we can enjoy our lives. My wife comes back and says, yeah, it's a great idea. Let's go ahead and do that. We do, and I can consider that acquisition debt. So that's not a major issue there. Okay. Points. Okay, so when you buy a house, typically if you want to get a lower interest rate, what'll happen is the employer will come up to you and say, okay, you want a lower interest rate? Fine, we can do a lower interest rate, but I'm going to have to charge you points on that. Basically prepaid interest. If you're going to own the house for the long term, points are actually a good thing. If you're going to own the house for like 7 years or less, generally not a good thing. Okay, and around 7 to 15 years is really the time frame where it's kind of like, yeah, could be good, could be bad. Sometimes running a quick calculation to figure that out is going to be good. So if you have points because it's paid for, to get the loan, they're going to generally be deductible. The biggest thing that I think you need to understand here, it must be amortized and deducted over the life of the loan. There is an exception to this, and it's called the $1 million exception. The $1 million exception is that if it's under $1 million, and if you put cash down on the house. So, for example, I'm going to buy a house. They ask me to put 20% down. If you are under $1 million, you can claim that part of that cash down, that the first dollars of that cash down was used to pay the points on the loan, and then you can deduct it immediately. Okay, so that's important. Now you don't have to. You can deduct it over time if you want, and sometimes with some taxpayers, I found out it was a better deal to do that. I had one time where a taxpayer, they bought it right at the end of the year, so they didn't have a whole lot of interest. The prior house they lived in was a rental. They didn't get to do the itemized deductions. Taking the points at that point would not have helped them. I said, look, let's go ahead and amortize. That ends up working out. Now, if you sell the house before the amortization is worn off, deduct the rest and you move on. Okay? That's important. Real property taxes. So owners of real property generally have to pay property taxes. The biggest thing to understand about this, again, it's an ad valorem tax because it's always based on value. You have the $10,000 limit. That's the biggest problem that you have with paying taxes on a real property. How long is that 10 grand going to last? I don't know. I've been calling for Congress to get rid of it for years. They've never listened to me on that, so it is what it is. But the fact of the matter is that you have that $10,000 limit. So if you're living in a high tax jurisdiction, it's probably not going to help you anyways. But if you're living down in Texas where they don't have a state income tax, it's very valuable because of course in Texas they actually have high property taxes. But like in Florida, I didn't have very high property taxes, but because I didn't have an income tax, property taxes were very useful in order to be able to get a deduction so I could get that off of my taxes. All right, folks, so that's all I got to say about this. I want to say this is, again, my favorite chapter. I hope you guys have enjoyed it, and I look forward to seeing you in class.